Hello everyone, welcome to Rise IS. I am Alok Bardhan and in today's deep analysis session we will discuss a very important article from today's The Hindu newspaper on India's gross net FDI paradox. So, title of the today's article is Reality Behind the Falling Net FDI. So, this article discusses India's net FDI declined sharply despite a strong gross inflow, underlining impact of disinvestment, capital repatriation, and investor classes. So, please read this article very carefully because this article carries very important data and facts for UPSC Prelims Economy section as well as UPSC Mains GS3 Indian Economy section. This article carries very important data like FDI data, last 2 year FDI data, and what is the drawbacks and types of FDI, types of FDI. So please read this article very carefully. We have marked some important point from today's newspaper in this article. So we have chosen this article mainly because UPSC in 2015 asked a question on FDI which say justify the need for FDI for development of Indian economy, why there is a gap between MOU signed and actual FDI. Suggest radical step to be taken for increasing FDI in India. So the news about FDI and FDI concept itself is very much relevant and very much important from UPSC prelims as well as UPSC mains section. So now we'll see context of this article. So India's net FDI fell sharply to US dollar 7.6 billion in 2025-26 despite record gross FDI inflows from of $94.6 billion, which reflect rising disinvestment and capital repatriation. So now we'll see what is FDI. FDI is a stable, long-term, non-debt capital flow that promotes technology transfer, productive capacity. However, growing capital outflow are reducing India's net capital retention. So, in short, what is the core definition of FDI? Any investment which is 10% of company net worth, 10% or more than 10% is classified as FDI, and below 10% it was simply called as FII, foreign institutional investors. Now we'll see a regulatory framework of FDI. So investment by non-resident, the key term is non-resident in unlisted Indian firms or acquisition of 10% plus a stake in a listed company is called FDI. So here the key term is investment by non-resident and 10+% stake in listed company. And now we'll see regulation part. So FDI is governed by FEMA. So FDI is governed by Foreign Exchange Management Act 1999 and FDI Policy 2020 and administered by Department for Promotion of Internal Trade and RBI. So these facts are very much relevant and very important for UPSC mains examination. So now we'll see routes of FDI. So there are two routes for FDI. First route is automatic route. Automatic route is company who want to invest in Indian company or any individual, private individual want to invest in Indian company. So no need prior approval from government. So simply private individual or a company can invest in Indian company without approval of government, simply they can invest, and RBI later notify only the investment. So this route is called automatic route. Now second route is government route. Government route is certain sector or certain percentage of investment requires prior approval from government. So this route is called government route. Government route is for investment you need prior approval from government or government ministries. Now we'll see prohibited sector. Which sector is prohibited? So atomic energy, lottery, gambling, chit fund, tobacco, and manufacturing. These sectors is these sector comes under prohibited sector. Because all you can see lottery, gambling, chit fund, these and tobacco manufacturing, these sector create negative impact on Indian health system or Indian negative impact for Indian economy. So this sector comes under prohibited sector. And for atomic energy, due to liability, who will face liability in the case of accident? So this liability issue, so this sector also comes under prohibited sector. So now we'll see net FDI calculation. How we calculate net FDI. So gross inflow minus disinvestment and repatriations under BOP financial account is called net FDI. So now we'll see significance of net FDI. See, net FDI measures actual capital retention rather than gross inflows. So net FDI help in evaluating or in analyzing actual capital retention. So net FDI also identifies BOP, balance of payment vulnerability, and external sector risk. So these are very important facts. So net FDI helps in identifying BOP vulnerability and external sector risk. Next is reflect genuine technology transfer and industrial growth. So net FDI help in genuine technology transfer and industrial growth. And so the next is help align foreign investment with initiative like PLI and Make in India. So the net FDI help in align foreign investment with PLI and Make in India scheme. Now we'll see classification of inward capital flows. So first classification is real FDI, which is under real FDI. We'll see long term productive investment with technology transfer. These comes under the definition of real FDI. So what about financial investor? So private individual and venture capitalist and sovereign fund seeking medium term return, this comes under financial investor. Now diaspora and a special purpose vehicle investment. Overseas fund routed through offshore center is called diaspora and a special purpose vehicle instrument. Now we'll see corporate reorganization. Share, swaps, merger, debt equity conversions comes under corporate reorganization. The last is outward foreign direct investment. So investment made by Indian firms abroad comes under outward foreign direct investment. Now we see challenges. Challenges. So declining manufacturing FDI. So first challenges is declining manufacturing FDI. So real foreign direct investment accounts only 10.6% of effective inflows. I mean, rest FDI comes either through either through round tripping order through round tripping or for simply tax evasion for tax evasion purposes. Now we'll see high private equity and venture capital exist. So financial investor contribute 40.5% of inflow, causing large outflow during exits. So high private equity or venture capital exits simply because financial investor contributes only 40.5% inflow, which causes large outflow during exit. So investor for the seek of for better return or search of tax haven generally exits or if some major economy like USA giving high return on investment, so simply they sell their investment and invest that money in abroad or for better or safe options. So high private equity and venture capitalist exist and non-fresh capital inflows. Around 40 billion since 2014-15 came from internal restructuring rather than fresh investment. So 40 billion since 2014-15 came from internal restructuring, means internal reaccounting and reinvestment type rather than fresh investment. Then next is round tripping risk. Nearly 45% of outward foreign direct investment flows into offshore holding entities. So round tripping is something which you do for tax evasion purpose. So same, if you have firm A and and in India, and here tax is 18%, and so you open an account B of same company in country B, which may be Singapore or another tax haven country. Here corporate tax is 0%. So Indian firm opened a branch in tax haven country which has near 0% or very minimum interest rate, very minimum tax rate. So they say, and company A is doing business in India. So they say our company, our branch, which is in India, is a sub branch of head office, which is in tax haven country. So this process is called round tripping for tax evasion. Now, next is outflow inflow gap. This including disinvestment, dividend, and royalties. About $1.50 exits every $1 entry. So every $1 entering in India results into $1.5 exits as dividend and royalties. Now, what is way forward? How can we tackle this? So, prioritize greenfield and manufacturing FDI through targeted incentive. So, what is greenfield? Greenfield is something when no industry exists earlier, so completely new industry or new branch is called greenfield investment and manufacturing FDI. So, these investment through targeted initiative improve FDI reporting by separating fresh inflow from accounting adjustment and strengthen ease of doing business, infrastructure and reinvestment initiative, and develop deeper domestic market to absorb when private individual and venture capitalists smoothly. Now tighten monitoring of round tripping and offshore cell entities. improve tracking and capital flow through Gift City and International Financial Fintech City, International Financial Service Center. So, strong gross FDI. So how we conclude this? We conclude because due to a strong gross FDI inflow indicate continued investors' interest, but rising capital outflows and low manufacturing oriented investment weaken net FDI. India must focus on maintaining high quality, technology intensive, and long term investment to support sustainable growth, manufacturing expansion, and macroeconomic stability. So, thank you for attending today's session. You can download complete PDF from our website, and for further preparation, please visit our YouTube channel and our website. Thank you.